Greetings. My name is Vino Mapetere, and I am the CAA Executive Head of Operations, Academic Operations. And today I would like to do a short lesson on the application of the meaning of incurred in taxation in the Income Tax Act of Zimbabwe. So the learning outcomes is to just have a quick look at what does incurred mean, and what, as students of the chartered accountancy students, what common pitfalls students fall into for their exam purposes. So let's start with the meaning of incurred. A quick overview, then we'll look at incurred in a context of cash transactions. Under cash transactions, I'll cover prepayments, cash trade, and then let's look at credit or non-cash transactions, that kind of context. And also let's look at where, for accounting purposes, there is prudence in terms of provisions and so on. Let's start with the overview. Incurred can generally be taken to mean when a transaction, when a taxpayer becomes unconditionally liable, or that taxpayer has an inescapable obligation to pay. So this is not defined in the Income Tax Act, and we've had to rely on case law to come up with this understanding of what does incurred mean. A taxpayer enters into a transaction, and out of that transaction, they are now liable, and there is no condition to that liability, or the obligation, that liability is inescapable. You will have incurred. So an amount is generally regarded as incurred if that happens. And we've got some cases to support that, and you can have a look at these cases I've mentioned. But basically, the courts are clarifying that the expenditure must be due and paid. So let us look at the indicators. The indicators of whether that inescapable obligation now exists is there must be a binding contract or agreement that should have been entered into. So remember, agreement can be a written contract, it can be verbal, but it must be binding. So your business law comes into, your law of contract comes into play. And your supplier, or the one that is owed, has performed their part. If they delivered those goods or services, and that the paying taxpayer has no further conditions to fulfill before being required to pay. Under such circumstances, we are saying, yes, there is an inescapable obligation. So let's do a quick mind map to test whether incurred has happened. So the map starts with, do you have a binding legal obligation? And like I said, law of contract. to have an agreement, and is that agreement binding? And then within that agreement or that application, has the performance part been done? So we can agree that you will supply me with tomatoes and I'll pay you tomorrow. But unless the tomatoes have been supplied, this payment will still not have been performed. It's escapable because the tomatoes have not yet been supplied. So performance of the obligation has not yet happened. And then is the obligation unconditional? To say, I will pay you the tomatoes if you supply them and if the tomatoes are half green and half red. So tomatoes could have come, but as these conditions, do we still have an outstanding condition to say, unfortunately, the tomatoes were supplied, but they were all red? That condition. I will pay you your rentals depending on how much I make in terms of my own revenue. So that's like a conditional obligation. And unless the condition has been satisfied, the inescapable obligation does not arise. Has the amount been determined? So yes, you pay me tomatoes, but how much? I have delivered the tomatoes. We have agreed. We have a contractual obligation. We have a legal binding obligation that says, if you supply tomatoes, I'll give you money. So that part is done. And then have the tomatoes been supplied? Yes. And have all the conditions around the tomatoes been fulfilled? Yes. But we didn't specify how much for each bucket of tomatoes. So if we agree on $15, yes, we're building towards an inescapable obligation. And then, does it relate to the current tax year income production? So section 15.2a 2 will then still look at relating to which period in which these tomatoes were supplied. If we agree today and the performance is going to happen next year, it then does not relate to this year of assessment. And obviously we would have to look at the exclusions. Exclusions, obviously we're talking about their prohibited deductions and all the other conditions, such as is it not capital in nature, so you can't get a deduction, or was it for the purposes of trade or in the production of income? So if those conditions are not met, there's still an exclusion there. So let's look at the cash transactions as examples now. Now that we know what incurred means, inescapable obligation, and we've come up with some roadmap of short tests that you can then do, let us look at some of these transactions, cash transactions. So cash transactions, you can have prepayment. So with a prepayment, actual transfer of cash has happened, but performance by the supplier has not yet happened. So therefore, and for the avoidance of doubt, section 15.2 subsection A subsection Roman numeral 2 will then not allow this payment to be viewed as an allowable deduction because the performance hasn't happened yet. Let's look at a cash trade where the taxpayer pays and the goods are delivered simultaneously. There is an inescapable obligation. It is very clear what the obligation is, and so on and so on and so on, and therefore it must be deductible. So a quick example, CAA orders its stationery from two suppliers. Supplier X sells on a cash basis and collects cash on delivery. Supplier Y, on the other hand, creates customized stationery after down payments have been made. So you go to this supplier Y and then they say to you, yes, we can do stationery for exams that are CAA branded. However, you have to pay a deposit because we've got to fix the stencils and we've got to make sure that this is an order which we can make good, since it's customized to CAA only. So we can't produce for CAA and then CAA says, no, wait, we're not ordering yet at this stage. What we can do is to start configuring our machinery if you give us a down payment. So this prepayment, the question then is, has it been incurred? And we are saying, is there an inescapable obligation? Does it relate to the current period? And section 15.2a will then say, look, if, like in this case, CAA went on the 20th of December and they were told 19th of December, paid some down payment, and they were told you will receive it 1 month later, which is in and around the 19th, 20th of January 2025. So in the year 2024, there's been that prepayment, and section 15.2a will say, look, this is not allowable as a deduction in the year 2024 because the performance has not yet happened in terms of the delivery of the stationery. Let us look at credit transactions. Again, the question of inescapable obligation still arises. Under this, the delivery has happened. The payment is the only one that hasn't happened. So there is an obligation to pay. It is due and payable, and therefore you can then get it deducted. However, let's look at other transactions where no cash has passed hands, but does it follow that an inescapable obligation has happened? So for example, contingent liability. Remember, for accounting purposes, this is for disclosure only. You are noting that we have a court case, and it is very possible that we may lose this court case and it will come with these costs. The legal costs, plus maybe if it was a civil case where we're supposed to reimburse someone. All this is part of purposes of trade, and so on and so on and so on. So in terms of incurred, you have still not yet incurred. However, even if eventually we get to pay, it might not be deductible in the year we do get to pay. Why? Because maybe we've lost a court case in which we were then viewed as acting outside the law or in the capacity of a lawbreaker. So it's now a different case where we've incurred an expenditure or loss. However, it's still being disallowed using another section, which is a common student pitfall. Students sometimes confuse which principle is causing the disallowance. In some cases, you haven't incurred it yet, whilst it's still a contingent liability. So you're still not going to get a deduction. But maybe you will eventually incur it. But now the problem is, although you've paid and there's an inescapable obligation or an unconditional obligation to pay, or you've actually then paid it, although you have incurred, you might still not get a deduction, because now we're looking at a prohibition, a section 16.2 story, or the section 15.2, but trying to connect this activity that you did as a lawbreaker to your purposes of trade. So you still then don't get a deduction. As a candidate, the issue is your ability to articulate which one are you causing a disallowance on. Is it incurred, or is it an issue of capacity as a lawbreaker? You still have other accounting arrangements that do not involve the movement of cash immediately, like provision for leave days. And so the question is, should an entity get a tax deduction? So for accounting purposes, as you accrue these leave days, as staff becomes entitled to their leave days, you can be prudent and deduct or expense them. But sometimes what then happens is, sometimes you then don't get to pay them out as cash in lieu of leave, or they get forfeited in the future for some reason. Maybe within your contract, there's something that then allows in future, maybe the employee has been dismissed under certain offenses, and then they forfeit their leave days. In the meantime, for prudence, we would have already expensed them. So at that point, we would still now go and extinguish the provision and reverse the expense account. But the question is this what happens for tax? As the leave days accrue in the leave provision for leave days account, can we get a deduction? And the answer is no, because there's not yet an inescapable obligation to pay on the part of the employer. So that's another context in which incurred becomes applied for the purposes of, but it's different when you're now paying out cash in lieu of leave. You're actually incurring that. Restructuring provisions is another example, whereas let's say it's a mine, we may then be looking at restructuring, or we're looking at things like reclamation. So as we are doing our work, we will always keep in mind a provision that we are going to reclaim this land and refurbish or deal with environmental issues. So we unwind that provision by expensing over time. So that's prudence, that's good accounting practice, that's so that we are not overstating our profits in other years and so on, because this is an obligation that comes over time. So this allocation of this expected cost over the period, question is, as we are allocated over this period, do we get tax deductions? And the answer is no, when there is an inescapable, when there is not yet an inescapable or an unconditional obligation to pay it. Customer loyalty programs, the same. As customers accumulate loyalty points, which they may or may not redeem in future, from an accounting perspective, we'll do, what is the probability? Yeah, so let's always never overstate that we're making profit, yet out there could be people who have a legitimate claim on some of the value that we've created. So let's always be prudent there. But for tax purposes, unless this money has been claimed, you can go to the taxpayer and say, give me a deduction because I have lost. Remember, Section 15.2 says that it's an expenditure or loss. So you've not yet spent and you have not yet lost. So you can't get a tax deduction for that. So that's what happens with customer loyalty programs and such type of provisions. Then we also have these other provisions like depreciation, bad debts, amortizations. All these, we're still saying, apart from the fact amortization and depreciation can be, especially depreciation, it's really an allocation of a capital, or an amount of a capital nature. So you can still argue that depreciation in itself, in substance, it's a capital nature item. But under incurred, we still have a problem that, has it been incurred? Remember, it's an estimate of that allocation of the life, to say I'm losing value at this rate, and I'm going to spread it over the useful life, obviously taking into account the residual value of that asset. And we're saying this estimation across this useful life, is it what is exactly happening in terms of the actual loss of the value of the asset? So that obligation, that loss is conditional, and it's not exact science, so it hasn't been incurred. Right, moving on. Some other provisions, okay, I've already touched on contingent liabilities, but think about pending court cases, think about turnover rentals for provisional items and contingent liabilities. So some of the common pitfalls are your disallowed prepayments are not incurred. To say, whenever you disallow a prepayment, it means it was not incurred. All we're saying is it's disallowed because specifically Section 15.2A2 says, look, you've got to match getting an allowance in the year in which this associated income can accrue. So yes, conflating principles in applying them to the scenario. So in trying to argue for incurred, you start having candidates discussing purposes of trade in a discussion about incurred. You have say a provision, and then they say, no, this is not for the purposes of trade. Yet what you wanted to actually discuss was, has it been incurred yet? You also have claims that a provision is disallowed for tax purposes because it is a non-cash item, such as depreciation. Yes, depreciation is a non-cash item, but that's not a tax principle, whether it is cash or not. The issue is, has it been incurred or not, or can you argue it from the perspective of whether it is capital or not? Sometimes you get an argument that says, this provision is an accounting entry. Even revenue is an accounting entry, but we still include it in gross income. Even purchase of raw materials, they are accounting entries, but that doesn't stop us from getting a deduction. So the issue of whether something is getting a deduction or not is not fundamentally premised on whether it's an accounting entry or not. It's about the tax principle, and in this case, we're discussing the particular tax principle of incurred. So you do not get a deduction if you haven't yet incurred that expenditure or loss. So that's a common challenge with students. And then sometimes candidates confuse disallowing an expense as if it is the same as prohibiting it. So if I disallow an expense on the basis of because it has not been incurred, you cannot then say it is a prohibited deduction. Remember, prohibited deductions are found under section 16, where ordinarily they qualify to be deductible. But remember, the tax can be used as leverage to encourage or discourage certain taxpayer behaviors or transactions, and therefore a list of transactions may be okay. Under the rules, this ordinarily could have been deductible, but we're now prohibiting it, such as entertainment. You could have an expense or loss, purposes of trade and not capital in nature, in the form of entertainment. So if you go and pay for lunch with a potential client, you are entertaining them, it's hospitality. So is there an expense? Yes. Expenditure or loss. Has it been incurred? Yes, I've already paid. Inescapable. Is it for the purpose of trade? Yes, we were transacting. In fact, out of that lunch, we then clinched this big deal. And then is it capital in nature? No, it's actually revenue in nature. So ordinarily under section 15.2, that could have qualified as an allowable deduction. But it pops up under section 16 that says we do not allow entertainment. Entertainment defined as hospitality of any kind. And then once it has been prohibited, assuming that's the final position on that entertainment, if it pops up as a prohibition, it's different from it having been disallowed under section 15.2. So candidates in their explanations or in their calculations confuse disallowing an expense and prohibiting it. Calculation type questions, candidates also struggle to arrive at taxable income now, because sometimes, to use the example that I've just done, it now depends what had happened to this marketing expense within the accounts. If in the accounts this has been deducted as an expenditure, for you to work to taxable income, you will have to add it back. But in some cases, maybe you're doing the direct method. Nothing has been done yet. So for you to work to the taxable income, you are simply not allowing it. So you're not adding anything back, and neither are you deducting it. So that's a challenge. Where students with calculation type questions, sometimes they're not looking at establishing what had been done for accounting purposes before trying to treat it for tax purposes. Thank you.